Welcome to Small Practice Support information session number 43. In this Law Society of Ireland recording, Stuart Wan of Mercer talks to Justin Purcell about the options a solicitor has for saving for retirement.
So thanks everybody for attending. I suppose my role with Mercer is a client manager and responsible for the Law Society Trust Scheme, amongst other schemes, and Mercer will act as administrators and advisors to the trustees of that plan. So today we're just going to look at a high level of the kind of pension aspects in terms of your own pensions and the scheme itself. So from your perspective and individual perspective, there's three sources of pensions really: the state pension itself, any pension provision that you make either individually or through an employer, and then also any individual private savings you may have when you come to retire. So the state pension in itself, we know that it's kind of it is relatively good value in terms of, compared to European counterparts, it's a high level of income, but it's a costly benefit from a state perspective, and we've seen the state pension move to 66. It may go further to 67. That's out for review at the moment, but it may be harder to qualify for. But essentially, from a pension perspective, the state is unlikely to give you what you need when you come to retire. So in terms of saving, the benefits of saving additional pension provision is really to get yourself more money in retirement, access to better healthcare, obviously, and hobbies and pastimes. From an individual perspective, every pension or every person's retirement is different. Everybody has different needs in retirement. Some people will have paid off their mortgage, some people won't pay their mortgages. So essentially, it's a very personal aspect of financial planning is what you actually need to retire when you come to retire, and that's something that you should give thought to. So how to save for retirement? So for some people, you may have an employer scheme, so a defined contribution scheme or a defined benefit scheme or a group PRSA. And if you are actually eligible for such a scheme, then it's obviously important to be in that scheme, and essentially where there is a variable contribution rate from the employer, that you should actually look at maximizing the employer contributions and the benefits for employer as much as you can. You obviously pay less tax relief. You get the tax. You pay less tax. You get tax relief on your contributions. Pensions actually grow free of tax when they're invested, and it ensures you have more than just a state pension. From an individual perspective, then PRSAs, personal pension plans, executive plans, and retirement annuity contracts are the policies that you can take from an individual perspective. This slide really just shows the importance of saving, and essentially it shows you that if you were to pay a 5% contribution to a scheme, what you would receive as a pension. Now, the main illustration here really is that this kind of shows the value of annuities. So if you make a 5% contribution and start at the age 25, you're likely to get 12.5% of that salary that you contribute. So the key here really is annuity rates, or giving your money to an insurance company to pay you a pension isn't good value at the moment. But obviously, the earlier you start paying into a pension, the better it is. Obviously, if you're in a company scheme and the company pays additional contributions, it's going to vastly improve that position in terms of what you might receive, as it's free money from the company. In terms of contributing to the scheme, then there are limits on what you can pay into the scheme. You may already know this, but the total remuneration cap of €150,000, tax relief applies. And if you're a higher rate taxpayer, you get relief at 40%. And there's a maximum percentage that is based on your age. So the closer you are to retirement, the more you can actually pay as a pension contribution. So with the tax relief, just want to look here briefly at kind of the benefits of actually investing in a pension itself. So if you invest in an arrangement outside of a pension scheme, the cost to you may be €3,000, whereas in a pension, you obviously get the tax relief. So there's additional benefit for you there. Outside of a pension arrangement, the investment growth is taxed. Inside a pension arrangement, there's tax-free growth. And then when you actually come to retire outside of a pension arrangement, if you take the benefit out of the policy, there's no tax-free benefits. Whereas within a pension arrangement, if you go down the route of investing in a pre-retirement fund, €2,500 of that money would actually be paid tax-free. When you actually come to take the benefit, then there's tax deduction on the investment return on the benefits you would get from the pension arrangement. So essentially, what you're looking at is a tax deduction of income tax in USC. So essentially, when you look at the final value of the benefits that you may receive from the scheme, the value of what you would get outside of a pension arrangement would be in around €5,000. Whereas within a pension arrangement, it's closer to €8,000. So there's obviously benefits there during the period that you're trying to prepare for your retirement by investing in a pension compared to, say, putting money into an individual policy outside of a pension scheme. So just to move on then, just in terms of one of the earlier slides I mentioned about kind of investing early. So this slide really shows you that the importance of starting early. So this is based on somebody who contributes who has a salary of €40,000 and pays in a 10% contribution annually. So if you look at this in terms of what they will save over the period of time, this shows the likely outcome for the member if there was no investment return. So this is the increase in the value of their retirement account, essentially, whilst they effectively invested in a cash-like fund. So there's no return on this above inflation. If you look at the same investment, but with a 2% investment growth return, then obviously there's much more growth there. So this is just to illustrate really that investment is an important aspect of pensions in terms of when you're actually investing in your retirement account. And especially for younger members, obviously investment growth isn't linear. So for members who are approaching retirement, then it's important to protect what you've built up in terms of market volatility. So for members who are younger, it's important that you actually get that investment return as you're a younger member of a pension scheme. So from age 35 onwards, say to age 55, you have time for investment markets to react in a volatile manner, that your investments will recoup any short-term falls in the market. Whereas if you approach retirement, then you need to have your investment fund more protected. From the Law Society Limited Trust scheme, so this essentially scheme, as Justin said, was set up in 1975 and is for the benefit of members of the Law Society who can't avail of an occupational pension scheme. So essentially, as I said before, if you have access to a pension scheme from an employer, then you should by all means join that. The scheme itself is overseen. It's a trust-based retirement annuity contract. So there is a trustee in place who oversees the scheme, the plan, and the operation of the plan, and the trustee has to act within the guidelines of the Pensions Act and within those regulations. There's a transparent charging structure to the scheme, so there's annual management charges that apply on the funds, but there are no other charges on your contributions when you pay in or when you exit the scheme, and you have full flexibility. So essentially, you can pay contributions in at any time, on an annual basis, on a quarterly basis, on a monthly basis, and you can dictate kind of how and when they are paid. To support members, as I said in the previous slide, it's important to think about kind of protecting your benefits when you come to retire. And in order to help you do that, there's a lifestyle strategy, which I'll touch on shortly. And also an ability to choose your retirement age as to when that lifestyle strategy de-risks too. And we must also have an online access system that you can look at your benefits at any time. In order to find out information about the scheme, you can contact Mercer, obviously, but there is a link to there, which is on the Law Society website. From the member benefits section, there is a Law Society Trust section within the member benefits that you can see the booklet and other information regarding the scheme. Mercer OneView, as I said, kind of, it gives you online access, and there's also a helpline where you can ask questions of the scheme or get advice if you need it with aspects of the scheme itself. The trust scheme has a small number of funds available, so the managed fund, diversified equity fund, absolute return fixed income fund, cash fund, and long bond fund. So there is just an illustration of the management charges that apply to the funds and also the returns. And I suppose one thing there to note really is that the exceptional number of the 46.7% that's held, the 1 year figure that diversified equity. I suppose the main thing really here is that this time last year, at the end of Q1, was a very different world, and we were at the bottom of the market falls post-COVID. So this is reflective really of the rally that was seen in equity funds. So, it should be the case with all funds when you look at the investment returns. The 3 year and 5 year figures are much more kind of indicative of the more realistic returns you will see from a pension scheme.
So Stuart, just those returns, there's 4 or 5 different funds there. Are they just comparisons between the funds, or are they all, the Law Society managed fund is the fund?
Well, the Law Society managed fund is the main fund. So that basically, if you're in the lifestyle default, it will invest primarily in the managed fund. So this is a bespoke fund for the Law Society. The diversified equity fund is obviously an equity fund that has a wide range of equity funds. The fixed income fund gives an element of growth, but a low level of growth because it's invested in fixed income instruments. So the 2 and 5 year returns, the 3 and 5 year returns, sorry, would be more indicative of what you would expect from that fund. The cash fund is really just capital preservation, and then with interest rates being negative, pension scheme cash funds have to invest in AAA rated, basically liquid instruments. So, and interest rates really are yielding negative, and that's the impact there that you see on the performance. And then the long bond fund is a specialist fund, which is really invest in long dated bonds, which is to match the cost of purchasing a pension if you were to go down the annuity route. So whilst returns have been good, it will react in line with interest rates and bond movements. So they all do, they're not direct comparisons between the funds. They're all doing different things, and they're for different reasons.
Do you mind me asking, what's the difference between long bond and a cash fund?
So the cash fund is cash instruments, so banks essentially. The long bond is long dated European sovereign bonds, so German bonds, French bonds, and essentially that what happens is as interest rates move, and then the long bond fund performance will move. So if interest rates go up, then the bond fund returns will fall. So it's not really designed, it's not really in there in this fund or in any other pension scheme. It's not really put there to actually provide return. It's there as a match for somebody who wants to purchase an annuity. That's why it's deemed on there to be a specialist fund rather than a growth fund. Okay.
Yep, thank you.
Just the lifestyle strategy, just to touch on this. So when I spoke earlier, we were talking about the importance of growth in the earlier years, and as you approach retirement, to try and protect the fund that you have. So essentially the lifestyle strategy is in place here, which invests predominantly in the managed fund, but as it moves closer towards retirement, it's targeting a benefit for somebody who would invest in an approved retirement fund. Okay, so essentially what you end up with 25% is matches a 25%, the 25% cash fund holding that you have would match the 25% cash that you would be able to take from the fund as a lump sum, and then a mix of the managed fund and the fixed income fund to reduce your exposure to equities. One aspect as well of the lifestyle scheme here is that this is set to 65 in the scheme, but you can actually choose the information. You can actually choose the retirement age that you want. You know, if 65 isn't for you, you can change it to 60, change it to 70, whatever age you want, and then that target end date moves to that date that you have chosen. Just if we have time, then just quickly onto options of retirement. So you have the retirement lump sum, which is 25% of your fund if you go down the approved retirement fund route. You have the choice of annuity. So as I spoke about earlier, with interest rates being so low, annuities are poor value at the moment, and really approved retirement funds, you know, 95% of members in the scheme really go down the approved retirement fund, and they are proven to be a much more popular choice for people who are taking retirement benefits from defined contribution arrangements. And for some people who have very small amounts of money, you can take a taxable cash sum. So just on the approved retirement fund, then obviously there are restrictions in terms of the benefits you can take. So you have to have a guaranteed level of income to invest in an approved retirement fund. Otherwise, you have to invest in what's called an approved minimum retirement fund. And then you draw down from the fund the amount of monies that you want. And then there's restrictions on an AMRF. So there's a restriction up to 4% on an AMRF. And one of the key things here with approved retirement funds and the actual kind of pros of this that makes people kind of more interested in investing in annuity is really that it is completely, you can inherit this. So if you were to pass away, your approved retirement fund basically passes to your spouse. Whereas with an annuity, if you don't actually elect to say have a spouse's pension as part of the benefit from an annuity, then the annuity will just cease essentially. So you know, that's one of the key things for an approved retirement fund is that inheritable benefit side of this. And also your benefits, your investment actually grows tax-free whilst invested in an approved retirement fund. The only thing to bear in mind, because you draw down an income from approved retirement fund, is essentially that you could drain all your funds and deplete the approved retirement fund over time. So for an approved retirement fund, you have a wide range of funds with different insurance companies that you can invest in, shares, properties, deposits. So you know, the approved retirements are widely available on the market in Ireland these days. And I suppose, again, we come back to this aspect of investment growth. So if you have an approved retirement fund, say with 100,000 euros, just for example, if you don't actually invest that in something that gives some level of return, after 25 years, it will be depleted. But with a 2% investment growth, then you know that will extend the lifetime over which you have the approved retirement fund that you can draw down from. So again, investment growth over the period is also important.
So just there, Stuart, on that investment growth, I don't know whether you can see the chat on the right-hand side, but
yes.
there seems to be a lot of interest in what is the percentage growth in the past year, or there's some queries there around the Law Society managed fund growth. So do you want to talk about that a little bit?
In terms of the losses in the retirement trust scheme funds growth?
Yeah.
If I go back to this slide.
Yes, I think so. I think that's what they're referring to. Did you have a performance graph somewhere?
I don't have one to hand here. I can share with you we have on the website for members, we have the quarterly updates, so I can give performance figures for you to share. We can put on the member support as well.
So this website is the website for people who are participating in the Law Society retirement trust scheme.
Yeah.
Have a login to yeah.
Yeah, so I can share some of that information with you, just in terms of putting it on the member services site, maybe just to have it available. Yeah, I mean, look, essentially, kind of equities generally have done well over the past few years, and growth has been pretty good. So, you know, for most funds, investment growth is going to be positive. Obviously, the 1 year figures are impacted by the COVID pandemic, obviously. But yeah, I can send more detailed information in terms of the managed fund and the equity fund.
And are you able
Just
to
wanna
talk
put
then
it-
a little bit about the fund itself? And is it just focused on European equities? There's a query there. Is it just European, or should it not be worldwide?
Yeah, look, I kind of just bear with me a second.
Sure.
I have it is a broad, diversified fund, so it is invested in a number of different.
Yeah, listen, if you don't have it to hand,
arrangements.
yeah,
Yeah, no, I'll call it up there.
Yeah.
But yeah, I suppose the key here is this is a closely managed fund, so it invests in all sorts of things from absolute return strategies, multi-asset credit, passive global equities, emerging markets, low volatility equities. So the idea is that there's a wide level of diversification within the managed fund and the equity fund itself that gives it some kind of protection, some level of protection on as markets fall. So it's not a traditional equity fund. So if you look at some of the funds that are available, they'd be more specifically into one type of into just equities. They wouldn't have multi-asset credit, say, or absolute return strategies and such like.
And one of the questions there was how do you get a list of independent financial or pension advisors? Is that something you're able to advise people on?
We don't typically give out a list of advisors. I think you can check on the central bank or regulator website and get a list of QFA individuals. They don't like to use the word independent anymore. I don't think we're allowed to use the word independent anymore. It's more impartial investors. So look, I mean, we can put you in touch with somebody from Mercer if somebody wants help initially, just in terms of asking information about the scheme. And we would have our own range of advisors, obviously, that can assist. But yeah, I think you can get a list of advisors from the regulator or the central bank websites of
and we will be sharing the
or,
slides and your contact details at the end, so people can maybe make direct contact with you if they have specific queries. Is that okay?
Yeah, and I can give them any information they need regarding the scheme and past performance and how to join the scheme. And I suppose the key thing here really is that the actual scheme itself, if you do join the plan, then you're not signed up to the plan to be in it forever. You can pay in for a year and then not paying for a year. There's no charges that are going to be eroding this. There's only the annual management charge that reduces the level of performance. So, we're keen to actually enroll as many members as we can into the scheme, but that doesn't mean that this has to be your sole source of pension income.
And I know fees have been an issue, not around this scheme, but in general in the pensions industry, and the fees seem to be very favourable in this situation, and it's got a very strong, how would you say, governance scheme around it. So it's been around for a long time.
Yeah, and I suppose when you look at the annual management charge on the cash fund, if somebody's kind of close to retirement and just invest in the cash, that's an extremely competitive annual management charge. Obviously, the annual management charges change, if you compare it to a vanilla passive fund that actually doesn't have any active management within it. The funds, there are cheaper funds available out there on the market, but just in terms of the level of diversification you get here and the support as well, then in terms of the overall package, I think it's good.
So there's another question. Does the fund invest in fossil fuels? So this green economy, climate issue raising itself.
Yeah, so I couldn't say definitively not, but I mean, essentially Mercer have got a very strong view on ESG, and this is something that kind of, I suppose, in recent months has become part of more legislation. So I'm pretty sure it doesn't, and there is some level of screening there. I can't say definitively what it doesn't pay into at this moment in time. But essentially, what Mercer do is have a screen, an ESG screen there that kind of prevents investment in certain activities. But again, I can double check that in terms of how that screen operates and what is included and not included.
There was a question there just earlier on about funds held by UK pension trustees Brexit? Are they capable of being brought into the EU? If so, are there tax issues? That sounds like a tricky one.
Yeah, it is. Now, there's been kind of press releases from the UK in terms of cross-border schemes between the UK and Ireland. So I know if you're an Irish scheme, and I know from an Irish perspective, if you're an Irish scheme and you have UK members, then you need to have a UK trustee. So there is guidance out there, I think, from the Pensions Authority in terms of UK in Ireland. I'm not sure off the top of my head, but I know there is guidance available from an Irish perspective of Irish schemes that if there's UK members, then they have to have a UK trustee as one of those.
So just if anybody else wants to ask a question, we're just coming up to the end now, so we're running out of time. So if anyone wants to quickly put out another question, we'll happily take it. So there's a question there again on the performance. Why does the Law Society not switch into the diversified equity fund, which seems to achieve much better growth? This goes back to
yeah, I mean, the equity fund achieves better growth. The equity fund is an equity fund, so it's designed to be invested in equities. The managed fund is much more diversified, so it has much more of a, as we said, more protection on the downside, but at the same time, it won't have the same heights when equity markets are doing well. It won't actually outperform an equity fund. So, the point of having the two there is to give an option for members who do want slightly higher level of return and to be invested fully in equities.
So just in summary and wrapping up there, Stuart, do you have any final advice or just takeaways for people today if they haven't started? If they have started, what should they do? And there is asking a few questions at one time around the 41% tax there. This is the most efficient way to avoid paying tax and save. Would I be correct?
Yeah, I mean, there's no doubt you obviously have to pay tax on the way out, but from an income tax perspective, you have to pay tax pretty much on everything, and this is one of the few ways you will actually get to extract tax-free cash out of the scheme or out of an arrangement when you come to retire. So, from that perspective, pensions, definitely not saying that the be-all and end-all when it comes to retirement provision. People have their own properties or second properties, but it is an extremely important part of somebody preparing and saving for retirement. So, from our perspective, we're keen to see people make provision as early as possible, that they can afford to make, and also to make sure that they're aware of the investment choices that they're in and to take appropriate steps during the investment cycle. So, as we said, as you come closer to retirement, to be more appropriately invested, maybe as you reach retirement, and to think about what you actually need. So, in a defined contribution situation where you're building up a fund when you come to retire, to be acutely aware as to what that actually is going to provide for you when you come to retire, and to make appropriate provision for what you think you might need when you come to retire.
Okay, and I think that's answering Michael's question there around, do you not risk profile each applicant on the basis of what risk they can tolerate? Is that just...
Yeah, and I suppose that's down. It's down to each individual. I suppose our role really is to administer and support the scheme and put the best investment options available out for members of the scheme. In reality, we do rely on individual members to take their own appropriate advice in terms of what they want, and if they want assistance with that, they can by all means contact Mercer, and we can help them with that. But we don't really, there is the lifestyle is the default, which is the most appropriate, that the trustee feels that's available, the most appropriate fund range that somebody should be in who wants to build for their retirement. But there's no risk profiling as such in terms of how members should invest. So, if somebody's more cautiously minded, then they could be invested 50% managed fund, 50% in cash, or 50% in the fixed income fund. So, it really is down to the individual in terms of what choices they wish to make if they want to invest in the scheme.
Okay. So thank you very much, Stuart. We're coming to the end of the call today. So thanks very much for participating. Thanks everyone for joining us today for what's been a very informative session. Next week, we've got Colin Walsh. He's going to be talking to us about voice over internet telephony. So this is around remote working and office solutions. So we hope you'll join us next week, Wednesday at 1 o'clock. So enjoy the bank holiday weekend. Stuart, again, thanks very much. You've been a great sport. Sloan,
Thank you.
we'll see you next week.